Hi, this is Kris from The Apartment Dealer. Welcome back to The Apartment Dealer Show. This is where we bring you the information, the resources, the network of professionals that will assist you as you build your financial legacy through multifamily investments. We're starting a new segment series here. We're calling it 5-Minute Multifamily. Over the next coming weeks, we're going to break down for you in 5 minutes or less the major facets of underwriting and understanding a multifamily investment. We'll be discussing things like capitalization rate, gross rent multiplier, evaluating properties based upon price per square foot, price per unit. And then we'll move on to some of the more advanced underwriting such as cash on cash return, internal rates of return, and continue from there. But the idea being in 5 minutes or less, you'll have the information needed so that you can underwrite your next investment. Now, what qualifies me to teach in this arena? Well, I've been selling multifamily properties now for over 14 years. Total buildings is something like more than 300 multifamily properties. And these are not duplexes and triplexes. My team and I specialize in buildings that are 5 to about 50 units in size. And I'm also a landlord myself. We own, my wife and I, and other buildings with partners, multiple locations. I know what it's like to manage, to show up, to rent vacant units, to go through renovations. I understand both sides of the coin, and we're looking to share this information with you. So let's dive in. Now, there's typically 4 major markers when it comes to evaluating an asset. Those would be price per unit, price per square foot, gross rent multiplier, oftentimes referred to as GRM, and our topic for today, the capitalization rate, also known as a cap rate. Now, when it comes to this capitalization rate, that again is your assuming what will be your rate of return based upon the building's current income, based upon the current expenses of the property, annual expenses, annual income. What will be your anticipated return over the course of the coming 12 months? Now, cap rate does not take into consideration debt. So this is not cash on cash return. Maybe said differently, cap rate will tell you if you were to buy a building all cash, what would be your expected rate of return? So how do we calculate it? You take a building's net income divided by the proposed purchase price. That'll give you your capitalization rate in the form of a percentage rate. Now, net income. So of course, we're talking about taking the gross income less a vacancy factor, less property taxes, utilities, costs for maintenance and repair, having a reserves account, minusing out these various items, again, not taking debt into consideration, but what is our net income after those items? That is the number that we're going to take and divide by the proposed purchase price, which will give us our cap rate. It's very useful when you're trying to size up one building from another. You're pondering buying a 6-unit versus an 8-unit. Well, right there, you already have 2 different sized buildings. Matter of fact, the 6-unit property has 4 2-bedroom units, 2 1-bedroom units. The 8-unit building is all 2-bedroom units. So cap rate, like the other markers that we use to determine value, well, at least helps an investor size up 2 properties because there's never 2 of the exact same that you're pondering buying typically. And we'll tell you what is my anticipated rate of return. So let's do a simple example here. Let's say you're considering purchasing a property that's $1 million. That $1 million property collects $100,000 in gross income. The expenses, taxes, insurance, utilities, maintenance and repair, some money for reserves, and taking out a vacancy factor, that will give us our net income. Well, in this case, the expenses total $40,000. That gives us $60,000 net income. So we would take $60,000 divided by a $1 million purchase price. That would give us a 6% cap rate. Now, oftentimes we have investors who try to size up their own property. And the mistake they make is they take the amount of taxes, property taxes that they're currently paying and plug it into the equation. That is not how you would figure out a cap rate on a property that's going to be a new purchase. You have to take into consideration the property taxes when they readjust to the new value based upon the new tax rate, because we're looking at it from the buyer's perspective. That's the cap rate. Because oftentimes we'll have investors call us and say, well, I want to sell my building at X cap rate. They've done the math internally, but they only considered the taxes they pay. And maybe they bought their building 20 years ago and the taxes are a quarter of what they're going to be for the new investor. So they come to a false calculation, as well as maintenance and repair. Oftentimes investors will say, well, my building doesn't cost much in repair. I've done all the major items. Anyone underwriting a property may assume $500 per unit annually for the maintenance and repair costs. Another approach is individuals just take 35 to 40% right off the top and say, look, that's exactly what it's going to cost. That's the amount of the expenses for running any building. Thus, if I take the gross income, take 35, 40% of that number off the top, that's your true net income. That's how we're going to figure out the cap rate. So in summary, capitalization rates figured out by taking the net income, dividing it by the proposed purchase price. That will give you a numerical value in the form of a percentage rate. That is your cap rate. Number two, that percentage rate is telling the investor what is the assumed rate of return over the course of the coming 12 months should the income and the expenses stay the same as stated. And third, cap rate gives us the ability to size up multiple assets side by side to tell us how does one differ from the other in terms of its rate of return. I hope this information is helpful. Stay tuned for our next segment where I will break down gross rent multiplier, GRM, and what does that mean in evaluating your next multifamily property. Kris German from the Apartment Dealer, and as always, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Thank you.